And so we come back to the final part of our proceedings, and we have two excellent panels as we put some serious issues to people here. Let us start by redefining retail investments, in particular the global real estate futures. Now, we've talked a lot about retail, and I've banged on about the question of whether it's saturated and which markets are good, bad, or indifferent. But our next speaker doesn't just bang on about it from a matter of no knowledge like I do. He actually knows what he's talking about. Ladies and gentlemen, a very warm welcome for Jeremy Kelly, the Director of Global Research Programs at Jones Lang LaSalle from the UK. Don't touch the bell.
Allowing me to participate in the discussion today. Redefining retail investment, global real estate futures. So let's redefine retail. The global retail sector is going through massive structural change. Globalization, urbanization, digitization, mobilization, customization, they're all having a deep impact on the global retail landscape. The effects of multi-channel retail are only just being felt across the globe, but change is playing out fast. Consumers are leading, retailers are responding, and developers, owners, and investors in retail real estate are adapting to the requirements for bricks and mortars as it morphs into new types of property requirements. Click and collect, S-commerce, dark stores, pop-ups, they're all being added to the lexicon of the multi-channel retailer. At the same time, the swelling urban middle classes of emerging economies with their rising discretionary spend are providing a compelling growth opportunity for retailers and a welcome antidote to the low growth environments of most mature markets. Cross-border retailers are aggressively extending their global footprint to capture these opportunities. Investors are reacting, initially focused on the well-established investment markets of North America, Western Europe, and developed Asia. Activity is gradually spreading to embrace Central and Eastern Europe, Russia, China, Turkey, Romania, Brazil, and signpost deals point to a further widening of activity into new markets in Latin America, Southeast Asia, Middle East, and most recently Africa. There's an interesting story to tell here about globalization, but perhaps an even more interesting debate on Africa's role in the next wave of globalization and whether the continent can leapfrog the normal evolutionary processes and take its own unique route to maturity. Over the past decade, more than $1 trillion of retail real estate has been directly traded across the globe, a quarter of which has involved cross-border deals, but so far, far less than 1% of this has been traded in African retail real estate. But as we move into the next wave of globalization, investment activity is accelerating, it's deepening. We expect volumes to double over the next decade, and it will embrace the African continent. So let's take a look at the structural drivers that are boosting investment activity into retail property, at the different characteristics of retail investment markets across the globe, at the current and future patterns of global investment activity, and how these may shape and be shaped the African landscape over the coming decade. So, what are the key forces that are impacting on the global retail investment market? Well, first of all, let me just deal with the obvious first. The statistics simply speak for themselves. Any of the benchmark measures of growth over the next 5 years, whether it's working age population, GDP growth, retail sales, certainly point to where the action and opportunities will be for investors and retailers. Investors, developers, and shopping center operators are seeking to tap into the favorable demographics of emerging markets where the expanding brand-conscious middle classes are providing a compelling growth opportunity, particularly in the larger economies of the BRICS and the less familiar MIST markets. And now Africa is showing amongst the most attractive growth dynamics. So emerging markets certainly look an enticing prospect for investors that are struggling with the low growth environment of most advanced markets. And this is being helped by the frenetic pace of urbanization, which is concentrating the consumers into cities, making them easier for retailers to reach. We're now in a world where there are 500 cities with over 1 million population, 60 of which are in Africa, 30 megacities that are home to populations of over 10 million people, and 7 metacities of over 20 million population. Huge consumer markets here, and where every week more than 1 million people somewhere in the world move to a city. This is completely turning the economic geography of the world on its head, and this has deep implications for investor and retailer strategies. Quite simply, the choice for retailers has vastly multiplied over the last decade and will continue to do so as we go through to 2020. We at Jones Lang LaSalle have identified 660 cities, our global 660, that we believe will be on the radar of the global and the regional retailers. And many international retailers are already expanding aggressively into these cities, initially led by the luxury retailers, by the hypermarkets, by the big box retailers. It's now the fast fashion groups that are leading the way. Mango, we believe, is expanding by 500 stores a year. Zara has plans for 400 stores in China alone. International retailers will usually only consider direct market entry when there is a high-quality shopping malls to house their outlets. And often retailers and retailer developers will move into new markets in tandem with each other. So as international developers extend deeper into these new geographies, the quality of the shopping center stock is steadily improving, which is increasing the amount of investable assets. We estimate that today there's over 1.2 billion square meters of modern shopping malls. That's enough to cover the metropolitan area of Johannesburg 7 times over. So I think certainly the opportunities in emerging markets are not really without their challenges, of course. The issue of real estate transparency, which has been touched on in previous sessions, is a perpetual source of concern for investors. But transparency is gradually improving across the globe, and we've created our Global Real Estate Transparency Index, which highlights the top transparency improvers, a list that does include Johannesburg. And tellingly, investment activity in markets with the fastest improvement in transparency, such as Istanbul, such as Sao Paulo, Mexico City, and Bucharest, is growing at twice the rate of other emerging markets. There are potentially significant benefits for those high-growth cities that can improve their regulatory environment, ensure property rights, and enhance the fairness of their transaction process. Particularly as there is a huge weight of capital targeting retail real estate, as institutional investors and sovereign wealth and pension funds rebalance in favor of real estate over the traditional cornerstones of bonds and equities. And because of the relatively large size of bonds and equities compared to the real estate universe, even a small shift towards real estate could have profound implications on our industry. So a 1% down weighting in equity implies an 8% rise in real estate holdings across the globe. And we reckon there are about 150 major, serious cross-border investors who are creating multinational portfolios. Yet retail investment is increasingly being underpinned by the activities of a relatively small group of global players who are working to build very hard to build truly global platforms across multiple continents. Sovereign wealth funds, institutions, private equity groups such as Blackstone, CPPIB in Canada, GIC, and Ivanhoe Cambridge have been aggressively targeting dominant shopping malls and portfolio opportunities across the globe. Meanwhile, leading retail developers such as Westfield, Simon, Lendlease, Sonae Sierra are deepening and extending their footprints across the globe, often in tandem with their cross-border retailer clients. So as existing investors upweight in retail real estate and new players join the party, we estimate that direct commercial real estate transactions will exceed $1 trillion per year by 2030. That's double current levels. And with retail assets sitting at the top of many investor shopping lists, we expect as much as 30% of this capital to be targeted on the retail sector. So this deepening real estate liquidity, the exponential growth in the consumer classes, the rapid urbanization, are converging at a time when the retailers and the retail sector itself are going through a period of dramatic structural change as consumers are empowered by the internet and by the multi-channel retail, and where mobile devices are accelerating online usage. For example, the number of smartphones across the globe is expected to jump from less than 1 billion today to 5 billion by 2017. And the UK is certainly taking the global lead in this respect and is seen as a bellwether of activity. And here we believe that as much as 30% of the existing retail space is potentially surplus to requirement. And even conservative estimates suggest that that will be about 20%. So this is certainly helping focus the minds of investors and owners on the types of shopping malls they develop and acquire. And little surprise, therefore, that investors are focusing either on the very large dominant malls, the super regional, the regional malls, or the smaller convenience malls. So how are these structural changes impacting on the global retail investment landscape? The globalization of retail investment over the past decade has created a wide diversity of what we call investable geographies in terms of market conditions, maturity, and risk profile. Based on levels of investor activity, shopping mall development, real estate transparency, and international retailer presence, we've identified 6 categories of investment destination. And as we explore the characteristics of these groups, I would really invite you to think about where South Africa sits in this classification, which may provide some interesting pointers to the external challenges, threats, and opportunities going forward. So, plotting countries on what we call our retail investment evolution curve highlights the different types of investment destination. So in the far right, we've got the advanced markets of North America and Australia with their very well-developed retail infrastructures. Then we've got the transparent and highly traded mature markets of Western Europe and developed Asia, through to the transitional markets of Central Europe and Southeast Asia. And then we've got the growth markets that characterize your fellow BRICS and the mixed economies, and then the emerging and frontier markets that characterize large parts of Latin America and sub-Saharan Africa. It looks like a relatively simple construct of evolution, but unpicking the characteristics of these different groups reveals a complex tapestry of density, of dynamism, and destination. So, if we take shopping mall densities, for example, the amount of floor space per head of population, which is surely a measure of market sophistication. We can see that the advanced markets of the US, Canada, and Australia have the world's highest densities with their well-established deep infrastructures. South Africa, interestingly, likewise is found towards the top of the hierarchy with 400 square meters per thousand population, sitting alongside the Nordics, Japan, and UAE, effectively Dubai. Core Europe follows, but it's the original brick and mist markets that are catching up fast in terms of density and rapidly building out their shopping mall stock. And at the foot of the table, no surprises, we've got sub-Saharan Africa with the lowest concentrations of shopping malls. Clearly, shopping mall density reflects a range of historic, cultural, economic, and climatic factors. But if we're to believe that as much as 20 to 30% of this stock in the developed world will be obsolete due to the internet, then countries at the top of the retail ranking arguably may face issues of saturation and huge challenges of retrofitting, of adapting their stock to the multi-channel environment which is coming. The poorest quality space in these top-tier markets will just simply not survive. In the US, for example, 5 million square meters of store space is being permanently closed each year. That's equivalent of 1% of the stock per year. By contrast, the markets at the bottom of the ranking have a unique opportunity to leapfrog the evolutionary curve and arguably build malls that embrace multi-channel environment and that can learn from the mistakes of its predecessors further up the curve. Another measure of market dynamics is what we call retail investment velocity. This is the rate at which shopping malls are bought and sold, and this reveals quite a different pattern. The advanced markets of the US and Canada, and interestingly also South Africa, have low investment trading velocity despite having the large numbers of shopping malls. All three markets have ownership that is concentrated in the handfuls of relatively few institutions that have long-term hold positions. And so in the US, for example, public REITs dominate the ownership of regional and super-regional malls to a considerable degree. By contrast, the UK and Germany have the world's highest trading velocities. In the UK, the large number of institutions, public and private property companies, the high net worth individuals are all active in the market, meaning that assets are traded frequently. They are bought and sold on a regular basis. But I guess, I mean, for the retailer and consumer, are ownership patterns and whether a mall is turned over relevant to the retailer or consumer experience? You know, does it enhance or detract from that experience? Well, certainly the concentration of ownership does impact on the ability of cross-border investors to directly access markets. So in the advanced markets to the left, domestic capital accounts for over 2/3 of investment activity and as much as 80% in places like Canada and Australia. And again, South Africa appears to have characteristics similar to those advanced markets. In the UK and Germany, cross-border capital is more important, accounting for half of investment activity. Can we argue that cross-border trading enhances competition, embeds international best practice, and significantly facilitates the expansion of international retailers as investors, developers, and retailers move in tandem into these new markets? But another fact is that despite these apparent challenges and constraints of the well-established markets, and despite the attraction of the emerging markets, It's the advanced and mature markets, those at the top end of the maturity scale, North America, Western Europe, Australia, Japan, Hong Kong, Singapore, that still account for a significant 84% of global retail investment volumes. And it's probably even more concentrated than that, because if I show here the top 20 largest retail investment markets, the top three, US, UK, and Germany, alone account for half of global direct retail investment. It appears that there's still considerable inertia amongst global investors who continue to seek large, liquid, transparent markets. South Africa is just within the global top 20, in 18th position, with about 1% of the global total, with volumes comparable to Norway and Mexico. But here's the thing. Change is happening fast, and if we look at where the investment activity is increasing, it's happening in the growth markets, in Brazil, in Russia, in Mexico, in China. These are the most dynamic group with significant forward momentum, fast-track urbanization, rapidly rising brand-savvy middle classes, and high retail sales growth. These markets are building out their retail infrastructures and witnessing rising levels of activity from international retailers, developers, and shopping center operators. Liquidity is gradually rising in these markets, initially driven by domestic investors and developers, but signpost deals are alerting the rest of the world to opportunities in the likes of China, Brazil, Turkey, and Russia. So we've had recent acquisitions by the likes of Morgan Stanley in Russia, GIC and Blackstone in Turkey, Simon moving back into China, and as well as into Brazil. Any discussion on the globalization of retailing does need to acknowledge the massive growth of China, with its impressive and somewhat overwhelming list of growth statistics on urbanization, on the growth of consumer classes, the growth of retail sales, and the spectacular growth in shopping mall development. And while China is clearly taking its own route to maturity, its recent evolutionary path does perhaps hold crucial lessons for the building out of the shopping mall stock across Africa. China has been characterized by an overwhelming emphasis on scale over quality, and of speed of delivery, where communities are literally bulldozed overnight to make way for new malls. And once the assets have been built, professional shopping center management has usually been ignored, and they also forget the logistics component of a shopping mall infrastructure. In addition, shopping mall owners have usually focused on the prestige of luxury retailers rather than on those retailers providing for the mass market middle classes. And even the international retailers themselves have made mistakes, often misjudging the markets by trying to sell second-rate merchandise to what is in fact a very sophisticated, brand-savvy consumers that are demanding high-quality goods in a quality experience shopping mall. So does that ring any bells for what may or is already happening across sub-Saharan Africa? Which brings me on to how Africa, and South Africa specifically, will shape up or be shaped by the next wave of globalization of retail. Because as we move into the middle of the decade, the process of globalization is speeding up and is embracing more geographies driven on the back of the acceleration of cross-border retailer expansion, who are demanding quality shopping malls. We predict an uplift in global retail investment volumes of at least 50% by the end of the decade, and there'll be a general rebalancing of capital towards growth and emerging markets to account for a quarter of the global activity by the end of the decade, compared to less than 10% today. An increasing amount of that capital will be knocking on the doors of the African continent. At the same time, we're seeing new sources of capital directed at retail property. And the real game changer here is the sovereign wealth and pension funds, who have considerable firepower and are lining up to acquire high-quality retail assets across the globe. So Canadian, Norwegian, Singaporean, and Korean funds have all been highly active over the last 18 months. And the numbers are potentially quite substantial. For example, a 1% reallocation of funds of the 30 largest sovereign wealth funds towards real estate would increase the capital allocation by $40 billion US, which I believe is equivalent to the entire institutional real estate of South Africa. So, what is South Africa's position as this wall of money targets quality real estate? Where does it sit on the evolutionary curve which I shared with you earlier? And it's quite a complicated story, as you could probably appreciate. I mean, as I've highlighted and alluded to, in many respects, South Africa has more in common with the advanced markets of the US, Canada, and Australia, with high shopping mall densities, but with shopping mall ownership dominated by domestic institutions. Or, in other respects, it's more like what we call our mature markets of Europe in terms of the quality of shopping mall stock and the level of real estate market transparency. Other measures suggest it's more of a transitional market, and certainly the rate of mall construction, for example, is more akin to what's happening in Central Europe and parts of Southeast Asia. Yet, underlying consumer dynamics with its and rates of urbanization certainly point to a market that has characteristics of the growth markets of its fellow BRIC economies. But then when you look at the low level of direct international retailer penetration, where franchises have so far been the preferred route, it's more like an emerging market, and certainly from the perspective of a cross-border international retailer. And whilst no one would ever accuse South Africa of being a frontier market, certainly international retailers are treating South Africa as a tester location for the expansion into frontier markets in sub-Saharan Africa. So South Africa is several markets in one. And from an outsider perspective, it provides a unique and compelling blend of first world infrastructure and developing consumer markets. Moreover, its role as a gateway to sub-Saharan Africa for retailers provides an additional dimension. Because Africa has to date so far been largely off the radar of most international groups that are not part of the African continent. But this is beginning to change fast as international retailers, developers, and investors are looking to tap into the opportunity, as the continent has many of those ingredients for liftoff that we've seen in other continents. The explosive population growth, a youthful urbanizing population, above average, amongst the fastest rates of economic growth across the globe outside of China, selectively improving operating conditions, and most significantly, brand-conscious consumers who are looking for quality products in a modern shopping experience. I mean, South Africans are clearly setting the pace of moving into the region. You have first mover advantage, but competition is increasing, and as you know, it will be coming from less traditional sources, from China, from Southeast Asia. The focus is certainly on the four big markets, as you know, Nigeria, Egypt, Morocco, South Africa, as well as oil-rich Angola and the more stable economies such as Ghana and East Africa. But developers and retailers are moving well down the risk curve, which is testament to the attraction of these markets. Nonetheless, the persistent lack of transparency, which I mentioned earlier in the presentation, and the overall challenges of operating in these markets will continue to act as a constraint. Our Real Estate Transparency Index shows that while South Africa stands head and shoulders above the rest and above the BRIC markets in terms of real estate transparency, and places like Mauritius and Botswana and Kenya have some elements of a transparent market, the remainder of the continent, from a real estate transparency perspective, is firmly opaque, with countries such as Angola, Nigeria, among the world's lowest ranking countries in terms of real estate transparency. For retailers, the crucial strategic question for them is which of the African markets and which countries will rise above the parapet and become the new geography of opportunity. We at Jones Lang LaSalle have got a program called our World Winning Cities Research, where we look at city competitiveness. And we've identified 20 African cities that we believe, and I'll be interested in your views, that will make their mark on the retail sector going forward. They've been selected on the basis of the appropriate blend of critical mass, growth dynamics, or inherent attractions that would outweigh the risks of operating and moving into these markets. Some retailers will clearly have deeper footprints in Nigeria or Egypt, for example, but most international retailers, these will be the 20 cities we believe to watch. These African cities will be building out their modern infrastructure just at a time when the retail sector is going through fundamental change. And I will conclude on this. Consumers in both advanced and emerging economies are demanding new types of shopping experience and shopping malls that require new ingredients. So malls are now more about destination, about experience, about lifestyle. They'll be making more room for leisure and catering. They will need to consider showroom space that showcases brands for the multi-channel retailers. Malls are likely to perform a crucial role in click and collect models, and it'll all be about dwell time rather than footfall. It'll be about community engagement and involvement. It's also about energy, solar energy, water efficiency, more flexible lease models, and not least, an efficient and reliable logistics infrastructure, which is crucial to the multi-channel world. And in the UK at the moment, about 25% of all take-up in the logistics sector is because of internet retailing. Unencumbered by the legacy of old retail stock, African cities have the potential to build a retail infrastructure that responds to these sorts of requirements. Although you may agree with me, you may not, the imperatives of cost and of short-termism may dictate more standard models. By contrast, South African cities have greater capacity to adapt its existing retail infrastructure. So my final slide is about, in this rapidly changing landscape, the word resilience will be the watchword for any owner of retail real estate. So how do you build consistent performance in a world that seems to be speeding up in terms of geography, in terms of choice of location, in terms of format? And there are basically 4 key factors, which are not really rocket science. But first one is location. Perversely, in this technologically advanced age, location is becoming ever more important, and the physical and digital world are deeply entwined. Well-connected shopping centers that have a sense of place with a strong catchments will be most resilient, and we will see a much greater proportion of sales in these larger, well-connected cities. Secondly, assets. We will see a much stronger emphasis on asset management across the globe and value creation. And there will be more frequent repositioning of malls as new retail formats arrive and new catchments evolve. Third, we have the retailers. The majority of retailers will be net reducers of space as they go through rationalization in the advanced markets. So working with bricks and mortar retailers that are responding to these new opportunities of multi-channel will be crucial. Those retailers that operate physical stores as part of multi-channel strategies are outstripping retailers with an online presence only. Which then brings me on to the fourth one, which is technology. Future-proofing an asset by embedding new technology to ensure that data is effectively mined to draw consumers to the mall. While online retailing is still low in Africa, it is likely to grow rapidly, and we may be surprised by this. And there are already evidence of strong usage in cities such as Nairobi, as in Dakar. Certainly, the standard shopping center is likely to be a thing of the past. So as I've highlighted, there are some huge game changers here in the retail sector. These are not cyclical issues. They're radical structural changes that are fundamentally changing the shape of retail in terms of format and in terms of geography. Like it or not, South Africa will be part of this game change, and its future retail landscape will be fundamentally shaped by how it responds to the twin forces of globalization and digitization, the new cross-border, multi-channel world of retail. Thank you.